So can you tell us a little bit about yourself?
Yeah, sure. Jim Collins. I live in Greenwich, Connecticut with my wife and three kids, and I'm from New Jersey, and my wife is from Fairfield, just about a half hour north of here.
Cool. So could you explain what your job is?
Yeah, happy to. I work at Morgan Stanley. I'm a real estate investment banker. Before I did real estate, I was in mergers and acquisitions. Before that, I was an accountant, and I've been a banker for 26 years now. My clients are principally investors and owners of commercial real estate, so I don't really give personal financial advice, but happy to chat today in a social capacity and share with you some of what I've learned over the years.
So one of the things that we emphasize in our program is investing as a whole and how important it can be to set yourself up for your future. So what do you think the importance of mitigating risk is when investing, and how can that be done?
Well, you phrased the question the right way. It's about mitigating risk. You can't avoid risk. Leaving your house is risky. Putting your savings in a mattress is risky, right? Inflation's going to eat away at it. You could lose it. So it's just kind of minimizing your downside. And there's some common techniques to mitigating risk. First is diversification. You don't put all your eggs in one basket. So you can take some flyers and on some risky investments. If you had met Michael Dell was building computers in his dorm room and invested with him, it would have worked out great. But that's not always true of the flyers. So people like to have a balanced and diversified portfolio of established companies and then some other risky investments. Other ways are to manage your investing timeline, right? Like if you need money in the very near term, maybe stocks aren't a good investment for you because they're subject to volatility. So you want to manage timeline. You want to invest in established companies and markets where they're looking after investors, right? In the US, the stock exchanges have regulations that companies have to follow, so you can feel good about investing in them. You get published financial statements, research reports, and investor relations, and you can learn about the companies. Other ways of managing risk, you can do what's called dollar cost averaging, right? Which means you invest a little bit in regular intervals all the time, right? So you're in some ways indifferent to whether markets go up or down in the short term because you're always just going to put $1 in every month or something. That's called dollar cost averaging and smooths out your investing basis. There's another famous fundamental theory called value investing where you can get a margin of safety. So that's when you take a view on the value of an investment and you're buying it when it appears to be cheap versus the stock prices on the screen. So you can feel good about that. That's not exactly congruent with dollar cost averaging. Dollar cost averaging says you want to invest a little bit in intervals, whereas value investing is taking bets when you think something is cheap. I think it's kind of managing your time horizon, as I said earlier, is really important too. I think what young people have, which is really beneficial, is the value of time. And over time, stocks have been really the best returns. And it's volatile and hard to predict. Last few years have been great, but there's been times in the early 2000s that weren't. But in the end, time really is the ultimate determinant. And if you're young and investing for the long term, you really have that benefit of waiting it out and getting the superior returns.
So what are some general tips that you would offer to someone who's looking to invest in the first time or break into that in the future?
The trick is just getting started. What's great about technology and access now is that investing's been really democratized and you can get started for very low cost and you can get immediate diversity through exchange traded funds. And if you're not an adult, you can work with a custodial account where your parents would help you out. The most important thing for investing is you want to get on the right side of compound interest. Albert Einstein said, or at least people say from Albert Einstein, it's the eighth wonder of the world. If you're on the right side of it, your investments are going to compound over time and grow. If you're on the wrong side of it, you'll be paying consumer interest, which is interest on interest and very hard to get away from. So the sooner you start savings, the better. You have that value of time that I mentioned earlier. I would advise people to be a lifelong learner, right? I know some very successful business people who, you go out with them, all they really want to do is talk about new ideas, new things. They're constantly reading, constantly learning. I think you need to have just a general understanding of the tax code. And, I think some people start out investing and maybe they're day trading and then realize at the end of the year that, gains are taxable from year to year. And if you were to buy and hold, you can pretty much defer your gains over time. So you want to have just basics of the tax code. You probably need good advisors as time goes on in all areas of your life, be it legal, tax, investing. So get competent, capable, and honest advisors to help you through the cycles, because it's helpful to have people to bounce ideas off of and kind of keep your hands steady.
Awesome. Thank you.
Sure. My pleasure.